Welcome back to the deep dive. Today we are tackling, one of the most frustrating and costly structural flaws in modern business, the short-term trap.
Right.
You're a business leader, you've got this brilliant 5-year strategy, needs significant upfront investment, right?
Mm-hmm.
But then every 90 days, boom, the investment community demands immediate measurable proof that you're, crushing it.
Yeah, and this pressure, it often forces companies to prioritize that quick quarterly win over the truly transformative long-term stuff that really drives durable success.
Exactly.
It is the ultimate pressure cooker effect, absolutely.
Yeah.
And it fundamentally warps those crucial capital allocation decisions.
So leaders end up sacrificing things like, foundational R&D?
Oh, absolutely. Critical R&D, long-term infrastructure upgrades, essential brand-building marketing campaigns. I mean, investments that are just vital for the real economy.
All just to massage the quarterly earnings report.
Precisely.
So today, we're diving deep into the work of Sarah Keohane Williamson. She's the CEO of FCLTGlobal.
Right. That's the nonprofit focused on championing long-term capital allocation.
And specifically, we're looking at her analysis in her book, The CEO's Guide to the Investment Galaxy.
Yeah, and our mission today really is to give you a shortcut. We need to understand exactly how CEOs can navigate this often really confusing, sometimes contradictory investment landscape.
Because Williamson argues companies and investors, they operate with different time frames, different languages even.
Totally different languages, and often fundamentally misaligned incentives. Her book, it's designed specifically to bridge that gap. It's, like she says, an investment book written for business people.
Okay, and here's the big reveal we need to unpack right away, because it really dictates everything else. CEOs often think, perhaps comfortably, that all their shareholders are automatically, on their team.
Right, that comforting assumption.
We need to start by digging into why that belief is often just wrong, a critical error.
Yeah, that flawed assumption that all shareholders want the same thing. That's really the core insight from FCLTGlobal's decade of work. It's the biggest misconception Williamson points out.
The CEO looks out there and thinks, everyone who owns my stock wants us to succeed long term.
Exactly. But as she emphasizes, when you actually look at the mechanics of the market, well, it's not quite that simple.
Okay, let's unpack that. It feels counterintuitive. If you own a piece of the company, why wouldn't you want it to succeed long term?
Because the market isn't just one thing, right?
Yeah.
It's not a unified choir. It's, like Williamson calls it, a galaxy, a whole galaxy of different players. And they have wildly different incentives, different time horizons.
So a CEO needs to look at their cap table and see these distinct types.
Absolutely. Who you talk to matters immensely. You got to recognize these different players.
Okay, drilling down then, let's start with the clearest group, the retail shareholders.
Right. These are, everyday investors, individuals. They're generally buying the stock, hoping the price goes up over time. Simple as that.
So in that sense, they probably are on the team.
Yeah, likely. Their investment is pretty directly tied to the company's success. Now, their time horizon, that can be all over the place. But the fundamental goal, it aligns with long-term growth, generally speaking.
Okay. But then we get to the big institutions, starting with the index managers, the passive investors. These guys have to own tons of companies just to track a benchmark, right?
Exactly. And this is where it gets really, really complex and often kind of counterintuitive for the CEO.
How so?
Well, index managers, they hold shares in a huge number of companies, often a majority of firms in something like the S&P 500. They want your company to do well, sure, absolutely.
What?
But also want your competitors to do well. Their main concern is the success of the overall market, the whole system, avoiding systemic risk.
Right. Okay, that's the key difference. Why does that focus on the ecosystem clash with the CEO's goal of just, winning,
Right.
beating the competition?
Well, think about it from their perspective, the index manager's view. If one company tanks because of a bad strategic bet, it's a tiny drag on their massive portfolio. Annoying, maybe, but small.
Okay.
But if the entire sector, say, tech or biotech, if they all panic and slash R&D at the same time to hit quarterly numbers...
then the whole ecosystem suffers.
Exactly. The index manager takes a huge hit because they own the whole thing.
Yeah.
So they're actually less focused on company A beating company B.
And more focused on making sure company A's decisions don't screw things up for everyone else.
Precisely. that
Okay.
broad systemic focus. It's often a sharp misalignment with the CEO
Yeah.
who's laser focused on winning that internal battle against their direct competitors.
Oh, okay. That completely reframes loyalty. They're rooting against anything that destabilizes the system, even if it gives one company a short-term, maybe unsustainable advantage.
You got it.
Now, the third group, the active managers, you said they're the most chaotic. Their loyalty is totally conditional.
Oh yeah. Active managers are chasing alpha, right? Trying to beat the market benchmark by making specific calculated bets. So their motivation, it depends entirely on their current position relative to that benchmark.
Okay, and you mentioned two key terms, overweight and underweight. Let's break those down. What's overweight?
So if an active manager is overweight on your stock, it means they hold a bigger chunk of your company in their portfolio than its sort of natural weighting in the index.
They're betting big on you.
Exactly. They really want your stock to go up to prove their bet right. So yeah, they are genuinely on the team in that scenario.
Okay. And conversely, underweight.
That means they're positioned to benefit if you underperform. They think the market has overvalued your stock, so they hold less of it than the benchmark weight suggests.
So they might actually be hoping the stock drops.
They might be. If the stock falls, or even just lags the market, it proves their thesis correct and helps their relative performance. They're definitely not necessarily on your team in that case.
So a CEO looks at their shareholder list, sees a big institutional name, and has basically no idea if they're an ally or actively positioned against them.
That's the uncertainty. That's exactly what Williamson says. Just drives CEOs crazy, not knowing who's actually rooting for you among your big professional owners.
It creates so much noise.
And forces them to waste precious time and energy talking to this fragmented, sometimes even hostile audience.
Okay, so if the old idea of just serving the shareholder is too vague, too simplistic, what's the first step? What's Williamson's tactical advice?
Her advice is clear. You need an investor strategy. Just like you have a customer strategy, you need one for investors.
An investor strategy, how does that work?
First step is analysis. Figure out who owns your stock now. And maybe more importantly, which investors do you wish owned your stock? You know, the long-term, sophisticated institutional players.
So you're defining your ideal owner profile.
Exactly. And then you focus your time, the CEO's time, the CFO's time, which is incredibly limited on those investors who are on your team, or the ones who could be, the ones you want to attract.
So you stop just reporting to whoever dials into the quarterly call.
Right.
And start actively trying to build the right investor base, maybe going after that big stable pension fund that doesn't own you yet, instead of just reacting to the hedge fund that's in and out in weeks.
That's it exactly. The goal is to stabilize your shareholder register, attract that high-quality long-term capital, investors who actually share your vision and your time horizon, that active management of your owners. That's the foundation for resisting all that short-term pressure.
Okay, so you've got your investor strategy, but then there's the constant market feedback loop, right? The daily stock price swings, the commentary.
Right.
It's almost all short-term focused.
Or the noise.
And Williamson's research gives CEOs some armor here. She has this great quote: "What matters to the real economy is not so much the stock price or its volatility, it's how management reacts to it."
That's the core philosophy, isn't it? Resisting short-termism starts with understanding that volatility, that daily churn, it's often just noise, pure noise. It might have absolutely nothing to do with your company's actual strategic path or performance.
Can you give an example? We hear about macro events, sure, but what about those internal market mechanics?
Well, think about something called a factor trade. This is some jargon, but it's important.
Okay, demystify it for us.
A factor trade is when big institutions buy or sell huge baskets of stocks based not on individual company quality, but on a shared characteristic of factor, like size, value, momentum, growth.
So my company's stock might drop 5%. Why?
It might drop because a massive hedge fund decided globally to reduce its exposure to the momentum factor, and your stock happened to be in that momentum basket. Or maybe they're rebalancing away from small cap growth.
Even if my actual business is strong, my 5-year plan is humming along.
Exactly. But some giant algorithmic trade hits your stock, unrelated to you, and suddenly the CEO feels the heat from the board, from the media.
And that's the classic trap, isn't it? If the CEO reacts to that noise, that temporary dip from an irrelevant factor trade, by hitting the brakes on strategic investments.
Then they've created a real fundamental problem.
Yeah.
An entirely self-inflicted wound.
And R&D, research and development, that always seems like the first thing on the chopping block. Why is that?
Because it's discretionary spending, right. And cutting it boosts your profit and loss statement immediately. This quarter's EPS looks better if you slash the R&D budget today.
But the damage is hidden.
Totally hidden. The catastrophic impact, the lost pipeline of future products, the missed technology shifts that won't show up in the financials for maybe 3, 4, 5 years.
By which time the CEO might have gotten their bonus and moved on.
Could be. And cutting marketing or essential maintenance, it's similar. You get an immediate cash bump, maybe boost earnings, but you damage long-term brand value or operational health in ways that are really hard and expensive to fix later.
So the fix is two parts. Get those long-term investors, like we talked about, and crucially, stop feeding the beast. Stop playing into the hands of the short-term traders.
Yes, which brings us straight to the big tactical recommendation from FCLTGlobal. Get rid of quarterly guidance.
Just stop doing it.
Stop doing it. The data is overwhelming. Williamson points out it's already shrinking. In the U.S., it used to be over a third of companies. Now it's under a quarter. And outside the U.S., it's virtually unheard of.
Okay, why is giving that specific range, say, on $1.27 to $1.30 earnings per share, why is that so uniquely damaging to long-term health?
It immediately creates this psychological burden, a sense of obligation. It's just human nature. If leaders see mid-quarter, they might miss that narrow range they promised.
They feel they have to do something, anything.
Exactly. They feel compelled to act, often unstrategically. And that's when you get the dreaded quarter-end scramble.
What does that actually look like inside a company? What kind of scrambling?
Oh, it's making tactical tweaks that hurt the business long-term, but make this quarter's numbers look better. Maybe delaying a critical equipment purchase. Or pushing supplier payments into the first day of the next quarter to artificially puff up cash flow.
Or pulling sales forward.
That's a classic. Pushing distributors to take inventory early, offering crazy discounts just to book the revenue now. You do that quarter after quarter. You've fundamentally shifted your whole company's focus to hitting that short-term number. It completely disrupts your real strategy, your customer relationships, everything.
Now, for years, the argument for guidance was that it lowered volatility. Tell the street what to expect, manage expectations, keep things calm. Did Williamson's research back that up?
No, quite the opposite, actually. That's a myth FCLTGlobal definitively debunks. Their analysis shows giving that tight quarterly guidance, it actually increases volatility.
Really?
Think about it. If you set a super precise number, like $1.28, and you miss it by 1 penny, the market reacts violently. Because it's not just a miss, it signals that management's own forecasting, their internal controls, might be broken.
So you replace moderate uncertainty with these high-stakes binary outcomes, hit or miss.
Exactly. High-stakes volatility.
And this whole destructive cycle gets amplified by what Williamson calls the quite nonsensical consensus cycle. You said it's like a closed loop of self-inflicted pain. Walk us through that.
It is. It's genuinely a massive waste of time and energy. It starts when, say, the CFO or the IR team talks to the street, the analyst covering the company. They sort of hint at the internal numbers, the expectations.
Okay, so the company subtly guides the guides.
Pretty much. Then the street, all those analysts, they do their math, their models, their channel checks, whatever, and they generate a consensus earnings number.
Right, which is based partly on what the company just told them.
Correct. But then, and this is the crazy part, the CFO often takes this consensus number, which basically originated from their own hands.
And presents it back to the board.
Presents it to the board as this external objective target that the company absolutely must hit to maintain credibility with the street.
Wow. Yeah.
So the company then twists itself into knots, trying to hit this consensus number that they effectively created themselves in the first place. It's an echo chamber driving internal pressure.
Yeah.
Just nonsensical.
I can just picture the meetings, the resources, all focused on chasing a number they essentially made up. So if companies ditch the quarterly guidance, what's the alternative? What should they be telling the market?
The alternative is transparency, yes, but focused on durability, not pinpoint quarterly precision, meaning have a clear, credible, long-term roadmap, 3, 4, 5 years out. Talk about the quarter is just one step, one data point on that longer journey.
So focus on long-term KPIs.
Exactly. Report on things that show long-term health. Customer lifetime value trends, market share gains in strategic areas, progress on R&D milestones like patent filings, things that actually build value over time.
So instead of we promise $1.29 EPS, it's more like our goal is 20% growth in customer lifetime value over 3 years, and here's how this quarter's investments move us toward that.
Precisely. And then if the company doesn't hit what the street predicts for the quarter, which is often just their own guess anyway.
Oh, Williamson says, that's okay.
That's okay. The burden, the pressure, it only really exists when the CEO promises the number. Take away that self-imposed promise, and you take away the pressure to sacrifice the future for today.
Okay, this whole strategy of resisting short-termism, it really requires the CEO to be an active teacher, right? Educating the market, educating their own board. And that puts a huge amount of weight on the investor relations team.
A huge amount. An effective IR team isn't just passing messages back and forth anymore. They need to be a strategic intelligence hub.
What does that mean practically?
It means their job is to look under the hood, as Williamson puts it. Don't just accept the vague statement, oh, the market wants this.
They need to dig deeper.
Yeah. Analyze who is actually trading the stock. Is it retail, hedge funds, index funds? Why is it volatile? Is it factor trade, a macro shock? Something else entirely. And then they need to educate the CEO, feeding that intelligence directly into the company's overall investor strategy.
Okay. And a really critical part of controlling that narrative, Williamson stresses, is drawing a very clear, very hard line between shareholders and sell-side analysts. They're often confused, right?
Oh, constantly confused. And this distinction is crucial, especially for CEOs who might mistake the noise from the financial media, which heavily relies on analysts, with what their actual owners are thinking.
Because the sell side is,
by definition, not a shareholder. They don't have their own capital at risk in your company. They don't owe a fiduciary duty to your actual owners.
She uses a specific analogy for them, doesn't she?
Yeah, she calls them weather forecasters, which I think is really insightful and actually pretty fair label.
Weather forecasters? How so?
Well, what do weather forecasters do? They gather all the data they can, satellite images, historical patterns, ground readings, and they try to predict what the weather will be tomorrow or next week.
Okay.
That's what sell-side analysts do. They gather data, company reports, industry trends, channel checks, and they try to predict earnings, stock movements, sector shifts. They're making forecasts.
So if they're just forecasters, why does their opinion carry so much weight? Why do the press, and often boards, treat their consensus reports like gospel truth?
It's a mix of visibility and simplicity, I think. Analysts are highly visible, right? They're quoted everywhere daily in the financial press.
Yeah.
That amplifies their forecasts enormously.
And they provide a simple number. Consensus is X.
Exactly. A simple, quantifiable story the media can grab onto. Company A missed the streets number. Easy headline. And this is the critical part, the CEO's duty, the board's duty, it's not to the media. It's not to the weather forecasters.
This fiduciary duty to the shareholders.
Only to the shareholders, the actual owners. So companies have got to resist confusing that noisy daily weather forecast with the underlying climate reality that their long-term investors understand.
Okay, so the CEO knows who their target long-term investors are. They're tuning out the sell-side noise. How do they get their own board fully committed to the long view? Because boards feel that public pressure too.
Yeah, they do. The key is controlling the narrative, both internally and externally. And you do that with a consistent multi-year roadmap.
Not just an 18-month plan.
No. We're talking 3, 4, 5 years out. A detailed strategy that clearly lays out the milestones, the priorities for capital allocation. It has to be consistent, and it has to be transparent.
And repeated everywhere.
Everywhere. Same core message in sell-side meetings and shareholder meetings, and crucially in every single board meeting. Consistency builds credibility.
Okay, but I can hear a CEO pushing back here. What if I broadcast a 5-year plan and then, bam, a pandemic hits or a major supply chain crisis? Now I look foolish, locked into a plan I can't deliver. Isn't some ambiguity useful sometimes?
Williamson argues pretty strongly that opacity is deadly. You're actually better off setting a clear, long-term plan and then transparently explaining why you need to make course corrections when major, unforeseen stuff happens.
Like COVID or a war or big geopolitical shifts.
Exactly. Investors understand that stuff happens. Plans need to adapt. What they hate, what they absolutely will not tolerate, is an opaque black box, where they just have no clue what the company's actually trying to achieve over the next 5 or 10 years.
So clarity, even if it means explaining changes later, is better than deliberate vagueness.
Far better. Investors will forgive adaptation. They won't forgive being kept in the dark.
Okay, let's circle back to that investor strategy. If a CEO or CFO only has a few precious hours each quarter for investor outreach, they have to prioritize ruthlessly. Who should they really be talking to, and what should those conversations be like?
Yeah, this is critical. You absolutely have to talk to the people who actually make the buy and sell decisions. That means the portfolio managers.
Not just the analysts who feed them research.
Not just the analysts. Talk to the decision makers. And Williamson emphasizes understanding the different types of portfolio managers.
Okay, tell us more about those types. What are the nuances?
Well, broadly, you've got two main camps. First, there are the managers who start with an index, like the S&P 500, and then just make marginal decisions, overweight this stock, underweight that one.
Their analysis is more relative.
Often, yeah. It's comparative. They might have a decent grasp, but they're thinking at the margins. Then you have the second group, the fundamentalists, the managers who start with a blank sheet of paper and build a portfolio from the ground up based on deep fundamental company valuation.
Like a Warren Buffett type.
Exactly, the Buffett types. Those managers, they're generally much more knowledgeable about your specific company.
They've done the deep homework?
They really have. They ask much deeper, more specific questions about your competitive moat, your technology pipeline, your capital allocation choices, your management team.
So the advice is CEOs and CFOs should spend their limited time having real dialogues with those managers, not just giving a presentation.
Absolutely. It needs to be a dialogue, not a monologue. Ask them interesting questions. Seek out the perspective of, say, boutique managers who've made a specific, maybe concentrated long-term bet on your company.
Ask them why they invested or why they didn't.
Exactly. By engaging in those high-value conversations, the CEO gets incredible competitive intelligence, real market perspective, insights that blow away anything you'd get from a generic sell-side consensus report. It actually turns investor relations into a true strategic asset.
We've talked a lot about what individual CEOs can do, how they can resist the pressure, but ultimately this short-term bias, it feels like it needs systemic change, right? Structural change.
Oh, absolutely.
And FCLTGlobal's approach is interesting here. They focus on fixing markets from the inside out. They don't think there's some single magic policy bullet from regulators that's going to solve what is fundamentally a human behavioral issue.
Right. That holistic behavioral focus is why their work is so compelling, I think. They've built their whole strategy around three main pillars.
Okay, what are they?
First, they build community. They deliberately create spaces, forums, opportunities for investors, company leaders, CEOs, people who usually only interact through very formal channels to actually sit down and talk candidly.
About their different time frames, their misaligned incentives.
Exactly. It's about sparking those light bulb moments, getting people to realize they might be talking past each other, using different languages.
That sounds incredibly practical, just getting the players talking.
It is. The second pillar is conduct research. They produce really high-quality, practical, actionable research. Stuff companies and investors can use immediately to analyze long-term behavior, see the results, understand the mechanics. This provides the evidence base for everything they advocate.
Okay, community, research. What's the third?
Third is simply get the word out, share the findings, talk about how long-term behavior can actually work even within today's market structure. It's education and advocacy based on the research and community insights.
Now, Williamson sounds very sure about the diagnosis, recognizing that the whole system, the incentives, are currently built for short-term rewards. But how does she feel about the progress? Is the system actually shifting? Are we winning?
She's very confident in the diagnosis, yes. She knows what the problem is, what could cause short-termism, but she's also very realistic. She acknowledges the system is incredibly hard to change precisely because those financial incentives are so deeply entrenched.
So progress is slow.
Progress is slow. I mean, look, quarterly guidance is shrinking. That's positive. But the intense focus on quarterly EPS targets, that's still dominant. So no, they can't declare victory yet. It's an ongoing battle, really, against powerful structural inertia.
Okay, so if incentives are the big roadblock, then the board is really where the rubber meets the road, isn't it? The board hires the CEO, fires the CEO, and crucially sets their pay.
Absolutely critical.
So if we want leaders who think long-term, the board has to incentivize long-term thinking.
The board's responsibility here is just paramount. FCLTGlobal's work really confirms that old business truth. People are driven by incentives. It's human nature. If the comp plan rewards juicing the stock price for the next 12 months, guess what? You're going to get behavior that juices the stock price for 12 months, even if it harms the company down the road.
So what's the single biggest recommendation Williamson and FCLTGlobal push for aligning CEO incentives with genuine long-term value creation?
The big one, the key recommendation, is structuring CEO compensation so that a significant chunk of their stock, maybe even the majority of their long-term incentive payout, is locked up, restricted for 4 or 5 years after they leave the CEO job.
Post-tenure, wow, that's a radical shift, designed to stop them gaming the system on their way out the door.
It fundamentally changes the calculus, doesn't it? Especially in those final years in the role. If your own financial future is directly tied to how the company performs years after you've retired or moved on.
You're much less likely to make those short-sighted cuts to R&D or maintenance just to pump the stock before you leave.
Exactly. It forces you to care about the institutional health of the organization because you personally will inherit the consequences, good or bad, of the strategic decisions you made right at the end.
Okay, that sounds great on paper, fantastic even. But let's play devil's advocate. Won't the really top-tier, in-demand CEO candidates just say, no thanks? Won't they refuse a contract that locks up their stock for 5 years after they're gone? Does this put boards trying to implement this at a disadvantage in the war for talent?
That's the crux of the challenge, isn't it? It's a structural difficulty. It really requires boards to make a conscious choice, to actively select for leaders who see their tenure not just as a job, but as, a legacy-building exercise.
Leaders who care about the company's durability.
Right. If a board is willing to maybe accept a slightly smaller pool of initial candidates, they potentially gain access to leaders who are fundamentally mission-aligned, the ones who genuinely care about where the company will be 5-10 years down the road.
So it forces a trade-off for the board.
It does. Do you want the leader who's maybe most focused on their own immediate payout? Or do you want the leader who's focused on the institution's enduring value? Implementing this kind of structure sends a powerful signal to the market and to potential candidates about what kind of leadership the board truly values and intends to reward.
It really becomes the ultimate test, doesn't it? A test of responsibility, of commitment. If a CEO candidate balks at a structure that ties their rewards to the long-term consequences of their strategy, well, that tells the board pretty much everything they need to know about that person's real-time horizon.
It certainly clarifies things. # tag OTRO.
Wow. Okay, this deep dive into Williamson's work, FCLTGlobal's research, it gives us so much actionable stuff for any executive, any board member listening. If we try to boil it down, recap the most surprising, maybe sticky lessons, what stands out?
Well, for me, it's definitely that segmented reality of shareholders, understanding the index manager paradox, that conditional loyalty of active managers, realizing not everyone is automatically on the team.
Yeah, and the absolute necessity of separating those sell-side weather forecasters from your actual owners. Stop confusing media noise with investor sentiment.
And critically, I think, the completely self-defeating nature of giving quarterly guidance. Just stop doing it.
Right. By removing that tight self-imposed obligation, CEOs actually gain the breathing room they need.
Breathing room to focus on educating the market with that consistent multi-year roadmap instead of just constantly playing defense against stock swings that are often just noise.
So strategic success really hinges on the CEO developing that sophisticated investor strategy.
And having the mental fortitude, the discipline to resist that powerful temptation to cut R&D, cut marketing, cut the future, really just because the market is screaming for instant gratification now.
Which brings us to our final thought, building on that last section about incentives. What exactly does it take for a board to find, select, and support a CEO who is genuinely mentally prepared for something like a 4 or 5 year post-tenure stock lockup? Because the ultimate test of a CEO's real commitment to the long game, it isn't the fancy 5-year plan they present on day one. It's their willingness, years later, to maintain those expensive, crucial long-term investments like R&D when all the short-term pressures, all the media noise, all the quarterly volatility is just screaming at them to make the immediate cut.
That willingness to hold the line.
That willingness under fire to accept that kind of long-term risk and responsibility. Maybe that reveals everything about a leader's true commitment to the institution they lead. Something to think about.